What's going on, everyone? Welcome back to the channel. It's April 29th. SoFi just reported earnings earlier today, and the stock is getting hit hard. Shares are down roughly 13% on the day, trading around $16 per share. At first glance, this earnings report actually looks pretty solid. So the big question is, why is the market reacting like this? In this video, I'm going to walk through what happened in the earnings report, explain why the stock sold off so aggressively, give you my bear, base, and bull price targets around the 3-minute mark, and then talk about what really matters going forward if you're a SoFi investor. Let's dive in. Let's start with the headline numbers. SoFi reported roughly $1.1 billion in revenue this quarter, which was up more than 40% year over year and came in ahead of expectations. Earnings per share were 12 cents, right in line with what Wall Street was forecasting. Member growth remained strong once again, with around 1.1 million new members added, bringing total members to about 14.7 million. Loan originations were also a bright spot. Personal loans and student loans both posted strong growth, and deposits continued to rise, which helped SoFi fund those loans internally rather than relying on external capital markets. So on paper, revenue is growing, the customer base is expanding, and profitability is improving. That doesn't sound like a company that should be down double digits in a single day. So before we get into the negatives, let's lay out the price targets. Bear case, $12 to $13 per share. In a bear scenario, credit conditions worsen, consumer defaults rise, and fintech stocks stay out of favor. If guidance continues to feel conservative and investor sentiment remains weak, the stock could drift back toward prior support levels in this range. Base case, $18 to $20 per share. This assumes SoFi keeps executing, loan losses remain manageable, revenue growth stays strong, and the market slowly regains confidence. In this scenario, the stock recovers most of today's sell-off over time. Bull case, $25 or higher. This would require improving macro conditions, a turnaround in fintech sentiment, and re-acceleration in SoFi's higher-margin technology platform business. It also assumes the market starts valuing SoFi as a scaled digital bank rather than a risky fintech. Now let's talk about why the stock dropped 13% today. The first and biggest reason is guidance. Despite beating on revenue and meeting earnings expectations, SoFi did not raise full-year guidance. Management reiterated around $4.65 billion in full-year revenue and approximately $0.60 in earnings per share. In today's market, especially for growth stocks, investors expect upside surprises to come with higher guidance. When guidance stays flat, it sends a message that management sees limited near-term upside, even if the quarter itself was strong. That alone was enough to disappoint a lot of investors. The second issue is SoFi's technology platform segment, which includes Galileo and Technisys. Revenue in this segment dropped about 27% year over year. Management explained that this was largely due to a major client fully exiting the platform. This matters because the technology platform is one of SoFi's highest margin businesses and a key part of the long-term fintech infrastructure story. When that segment struggles, it puts pressure on the narrative that SoFi is more than just a lender. The third concern is credit risk and the broader macro environment. While SoFi's credit metrics are still relatively healthy, investors remain cautious. The market is worried about what happens if the consumer weakens, unemployment rises, or loan defaults increase. Fintech lenders tend to get punished quickly when these concerns resurface. Put all of this together, and today's move looks like a classic sell-the-news reaction. The stock had run up heading into earnings, expectations were high, and when guidance didn't improve, sentiment flipped fast. Now, zooming out, there are still a lot of things SoFi is doing right. Member growth continues to be strong, deposits are increasingly funding loan growth, and the company is clearly making progress towards sustained profitability. SoFi is no longer just an idea or a story. It's becoming a real scaled financial platform. That said, the market wants proof that this growth is durable across different economic environments. It's not enough to grow quickly when conditions are favorable. Investors want to see how SoFi performs when things get tougher. Here's what I'm watching over the next few quarters. First, credit quality. Charge-offs, delinquencies, and loan loss provisions need to stay under control. Second, the technology platform business. Investors want to see stabilization and eventually renewed growth in that segment. And third, guidance. At some point, SoFi needs to show confidence by raising forward expectations. So here's my overall takeaway. This wasn't a bad earnings report, but it wasn't good enough to justify the optimism that had built up in the stock. At $16 per share, short-term sentiment is clearly damaged. Long-term, the story isn't broken, but SoFi still has something to prove. Let me know in the comments. Are you buying this dip, holding your position, or waiting for more confirmation? If this video helped, hit the like button, subscribe if you're new, and I'll see you in the next one.